Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I'm Joe.
And I'm Sarah. Today is Tuesday, February 17th, 2026. It's great to have you with us as we kick off a shortened trading week in the U.S. Let's dive in. Looking at the U.S. markets this morning, we are seeing a bit of a hangover feeling as Wall Street returns from the holiday. S&P 500 index futures are currently down about 0.4% as of 7:45 a.m. in New York. The Dow and the Nasdaq futures are also sliding, and it seems the primary culprit is a cooling of the red-hot artificial intelligence trade. Investors are starting to question which companies are truly on the right side of the AI boom, leading to some profit-taking in the tech heavyweights. We're seeing Nvidia, Palantir, and Tesla all extending their recent losses in pre-market trading. The Russell 2000, which tracks small-cap stocks, is also under pressure as broader market jitters take hold. Among the individual movers, we're watching Danaher, Fiserv, and General Mills, which are seeing significant activity this morning. On the losing end, silver miners like Hecla Mining and First Majestic Silver are taking a hit as the price of the metal itself has dropped about 2%. It's a cautious start to the week, Sarah, with the market seemingly looking for a new catalyst beyond the AI hype.
Moving north to Canada, the TSX is telling a very interesting and somewhat resilient story. Despite the volatility in the U.S., Canadian consumer confidence has actually hit a post-tariff high. It's a bit of a surprise, but it's being driven largely by optimism among young adults. This comes even as our housing market and labor data continue to flash some mixed signals. There's a significant strategic shift happening in Canada right now that investors need to watch. With U.S. trade tensions simmering and President Trump's previous tariff threats still fresh in memory, Canada is aggressively embracing Asia. U.S. automakers now only account for about a quarter of the cars assembled in Canada, and the government, under the influence of figures like Mark Carney, is looking overseas to save the auto heartland. We're seeing a massive pivot in the oil industry as well. Sales to China more than quadrupled last year, and Ottawa is now setting its sights on India. On the TSX today, keep an eye on the energy and industrial sectors as they navigate this transition from a North American focus to a more global, Asia-centric strategy.
Checking in on the international scene, it's a bit of a quiet morning in Asia because of the Lunar New Year holidays, with major markets in China and South Korea closed. However, Japan's Nikkei and the Nifty 50 in India remain in focus. In fact, India is hosting a major AI summit right now, with tech titans like Sam Altman and Sundar Pichai in attendance. They're looking to tap into India's massive pool of young, tech-forward talent, which could be a huge tailwind for the Nifty in the coming months. Over in Europe, the FTSE 100, DAX, and CAC 40 are facing some headwinds. There's growing tension within the EU regarding the latest round of Russian sanctions. Some countries are resisting plans to penalize foreign ports and banks used by Russia to sell oil, which is threatening to blunt the effectiveness of the bloc's policy. In the commodities space, we're seeing a retreat. Gold has fallen near $4,900 an ounce, and silver is also down. Oil is particularly volatile this morning, swinging between gains and losses as traders weigh military drills in the Strait of Hormuz against the resumption of U.S.-Iran nuclear talks in Geneva. In currencies, the dollar is edging higher for a second day as traders bet that the Federal Reserve might not be as aggressive with rate cuts as previously hoped.
Let's get into some specific corporate stories moving the needle in North America. First up, Snap is making a major play to diversify its revenue. They are launching creator subscriptions, moving into the space occupied by the likes of Patreon and OnlyFans. It's a crowded market, but Snap is betting its unique user base will follow their favorite creators into a paid model. In the banking sector, Morgan Stanley analysts have named Citigroup their top bank stock pick. Citi shares recently hit a 17-year high, and the bulls think there's still plenty of room to run as the bank's profitability continues to improve. Meanwhile, we are keeping a close eye on the crypto space. Michael Saylor's strategy continues its relentless accumulation, purchasing another $168 million in Bitcoin last week alone. They now hold over 714,000 BTC. It's a bold bet, especially since Bitcoin has been under pressure recently, hovering around $68,000 after a stress test that saw prices dip toward $60,000. Finally, for the earnings watchers, keep an eye on Palo Alto Networks and Texas Roadhouse later this week. They'll give us a good pulse on both cybersecurity, spending, and consumer discretionary health.
Transitioning to international corporate news, Alibaba is making waves in China. They just unveiled Qwen 3.5, their latest AI model, which shifts the focus toward AI agents. The chatbot race in China is evolving rapidly into a race for functional agents that can perform tasks, and Alibaba is positioning itself as a leader there. In Europe, the British catering giant Compass Group has made a move that's causing quite a stir in the City of London. They've announced they are switching their trading currency to US dollars. This is a significant blow to the prestige of the London Stock Exchange and reflects a broader trend of European companies looking toward the US capital markets for better valuation and liquidity. Speaking of exits, the Swedish utility Vattenfall is poised to exit the French energy retail market. Changes in French regulations and declining prices mean they can no longer buy discounted power, making the market unattractive for them. Also, in the banking world, the Italian giant Intesa Sanpaolo has disclosed $100 million in Bitcoin ETF holdings. It's a relatively small amount for a bank of that size, but it signals that major European institutions are slowly but surely integrating digital assets into their portfolios.
On the economic and geopolitical front, the big story is the tug-of-war over interest rate expectations. While some analysts at Goldman Sachs see 2 Fed cuts coming in the second half of 2026, currency traders are currently betting on fewer cuts, which is pushing the dollar higher. We're also awaiting the latest FOMC minutes and PCE data later this week, which will be the real deciders for market direction. Geopolitically, the situation in the Middle East has taken a tense turn. Iran has partially closed the Strait of Hormuz, a vital choke point for global oil, for military drills. This comes just as U.S.-Iran nuclear talks resume in Geneva. It's a classic case of saber-rattling during negotiations, but it's keeping energy markets on edge. Meanwhile, in Europe, there's a sense of frustration. A top security official recently remarked that Europe has failed to provide a unified front against the wrecking ball politics of both Trump and Putin, suggesting that regional powers are being left on the sidelines of major global discussions.
To wrap things up for our investors, the key theme today is definitely caution. The AI-driven rally in the US is facing a reality check, and the holiday-shortened week is starting with a defensive tone. Keep an eye on the $60,000 level for Bitcoin as it remains a major psychological floor. In Canada, the pivot to Asia is the long-term trend to watch, especially as trade relations with the U.S. remain unpredictable. Geopolitically, the Strait of Hormuz and the Geneva talks will likely dictate oil prices for the next few days. And finally, watch the U.S. dollar. If it continues to strengthen on the back of hawkish Fed bets, it could put further pressure on commodities and emerging markets.
That wraps up today's update. I hope you gained useful insights into how these global pieces are moving together this Tuesday.
Add your thoughts in the comments and follow for more such updates. This is Sarah.
And Joe, signing off. Stay savvy out there.